What is going on? Welcome to my channel. I am the Covered Call guy, and my goal is to create 120,000 in annual passive income using Covered Call ETFs. Right now, my portfolio yields me about $76,000 a year, 6.3 grand a month, 1.4 grand a week, and about $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, today's video was inspired by a conversation I had with my friend. I just started to talk about retirement plans and retirement goals. I asked that because he's actually way wealthier than I am. He has a few million invested, and he's and I just asked what he was invested in, and he said mainly growth, and if he does dividends, he does the 1 or 3%. And that's when I was like, what? Why don't you go for something, like, why don't you put some money aside for some of the little bit higher yield? And he was just like, no, that's risky, and he thought anything above 4% was too much risk. And I was just like, wow. I didn't blame him, because I used to be like that too. I used to be like the pure dividend grower with growth, and I guess I tried to explain to him what I was doing, and he just thought like I was crazy, to be doing this. So that kind of sparked an idea of like, well, am I crazy for doing this? Like, he's telling me, yeah, it's unsustainable. You can't get anything above 5% to sustain for the long term. And so this kind of just sparked the idea of like for this video. So I'm gonna go through my thought process and what I came up with. This is my opinion piece. So I'm gonna be exploring the 4 market areas and the 8 to 10% solution. I should really say 8 to 15%. Yeah, I would say 8 to 15%. I don't know why I put 8 to 10%. I would say more 8 to 15%. Why Covered Call ETFs or your safe haven for the next decades or the next few decades. All right, so let's get started on my opinion piece. All right, so the average lie, I think we get told this a lot, right? Wall Street or people on Reddit, X, or people just love to tell you stocks return 10% on average. And I like to say, I call BS on that, right? The market is lumpy. On average, like, what average are you talking about, right? I like to say it moves in distinct eras, right? We have a boom and we have a bust. If you plan for the average but retire on a bust, you go broke. So to me, saying, yeah, but it's unsustainable because the stock market can only return on average 7 to 10%, then you're going to limit yourself to those percentages, right? So I fell for that too. I mean, I'm not going to lie. But then when I kind of dug deeper, 7 to 10% was just recent. That's not a far-fetched thing way in the past. Those are recent numbers. And so I'm saying, if those numbers are recent, what can happen in the future? So, I kind of put my little formula together. That's how this channel is. I like to put scenarios. Right, so I kind of split it into the 4 market eras, right? So I've broken down market history into 4 distinct yield regimes, right? Understanding which era we're entering is the difference between poverty and wealth, right? Most investors are blind to this cycle. I think most investors stick to, the echo chambers of Vu and Chill. Nothing wrong with that, but I think a lot of people don't end up digging deeper or kind of opening their third eye to really see there's much more out there, right? So I would say era 1 is the stagnation, right? This is where, for the most part, the market will just give back 4 to 5%. Era 2 is the grind, 5 to 7%. Era 3 is the historical averages, 7 to 10%. I think era 4 is the boom, 10 to 15%, where we have been recently hitting those and even higher. There are periods where the market returns like 30, 40%. You can go ahead and Google this yourself, but I just kind of compressed it. I did it by like 1 or 2, 3 year compression, kind of average it out. And for the most part, it would, when you put like 30%, 10%, 8%, you kind of mix it in, get your averages out. to 10 to 15%. So when you have these cover calls hitting 8 to 15%, it's pretty sustainable. I would say you are pretty much hitting the mark. And for most cover calls right now are either matching the indexes or even beating them. So there's a lot to say about that. And that itself says a lot. All right, so let's talk about era one. All right, stagnation, right? 4 to 5%. So when this comes up, I think about the 1970s. I'm not that old to know about it, but this is if you educate yourself in the financial literacy world, you have to talk about the 1970s, right? So I'm in my early 30s. I don't ask me too much about it. There are probably people in the comments that have lived through it, right? The boomers. Nothing wrong with that too. Love you guys. All right, so think of the lost decade, 2000 to 2010, and this era, right, where stock prices go nowhere for 10 plus years. So these are all the scenarios here where a lot of things can happen to put us in the stagnation where the 4 to 5% return come from purely from dividends, right? Nominal returns are 4 to 5%, but real returns are often zero because remember, inflation, right, eats away at that. All right, so this is the buy and hold killer. This is where it pretty much you either hit 0% or you actually lose out on it. Like your returns go negative. And then we have era two, the grind, right? 5 to 7%. And I think this happens when valuation, PE ratios are high and need to compress. Companies make money, but the stock price doesn't move much because of the multiple, because the multiple is shrinking. You get decent earnings, but lackluster price action. It's a slow, painful grind up. And then we have era 3 and 4, right? I would say these are the good times. So era 3 is the 7 to 10%. This is the average here, right? I would say right now this is the Goldilocks zone, steady growth, moderate inflation. What the textbook promises, right? What everybody says, hey, this is the path to ruin chill. Just do this, and you don't have to worry about anything. And then I say era 4 is the boom, 10 to 15%. I would say this is mostly the last 5 years, fueled by 0% rates and tech hype, right? We are kind of leaving this now, right? I don't know what's going to happen in 2026, but I think we are going to be experiencing a rough ride because remember, rates are going down, but inflation is still up. So what does that mean? We might be entering a phase of stagnation. All right, the great rotation, right? We're rotating from era 4, boom, to era 1 or 2, valuation or at historic highs, right? The PE ratio over 21. And you know, the math says future returns must compress to 4 to 5%. If your plan rely on 10% growth, your plan is going to be broken. All right, the withdrawal nightmare. If you retire in era 1, 4 to 5% returns and withdraw 4% to live, you have zero margin for error. Now, of course, that is a little bit of exaggeration, right? You kind of have little leg room, but not much. All right, one bad year and you start eating away your principal. This is called sequence of return risk, right? When you have to sell basically in a downturn. And it banks for retirees, you know. Us income investors, we don't have to ever worry about this. All right. So what happens then, right? So that conversation with my friend, and this is where it kind of led me to what I was trying to convince him. There are other options. I was trying to introduce that solution to him. Covered call ETFs, reliable, sustainable, 8 to 10. I should have put 8 to 15. So I'm gonna say 8 to 15% yields here, right? We are the house. Right? Think of it as the casino, and we are the house. How do we get 8 to 10%? Okay, when you say 8 to 10, I should have put 8 to 15. So how do we get 8 to 15% when the market only gives 4%? We sell options, and when we say we, the fund we hold, right? So we, the fund, act as an insurance company for speculators. We sell them the upside potential in exchange for immediate cash. All right, factual standing, why it's safe. When my friend said, man, I don't know, anything over 4 or 5% is pretty risky. But when I try to explain this to him, I guess he just likes the 1 to 3%ers. Nothing wrong with that. And that's how I kind of broken it down to him, right? I trying to explain the VRP to him, variance risk premium, IV, implied volatility, which is just fair, and realized volatility, reality, right? So we have realized volatility at 15%, IV at 22%, which is fair, and our profit margin at 7%. That's our edge, right? The edge exists in almost every market era. It is structurally reliable. There's always going to be a market for options. And this is why I also talk about assets under management. That matters a lot. And I'm not a hater in a fund that has small assets under management, but it matters because when you're talking about options, you're talking about bid-ask spread. And when you're playing the millions to the billions, that eats away at profit. And these half a cent matters a lot when you're playing in the millions. All right, sustainability math, right? Of course, I got to talk about it because if I'm trying to convince my friend to try to look at a different path, right? Math matters, right? In a 4% market error, a covered call ETF generates about 2% dividends plus 8% option premiums. This is where we get our total yield of 10%. I believe that's very, very sustainable, right? We don't need the stock price to go up to get paid. We are market neutral, right, on price, but long on volatility, right? That's why it survives stagnation. And remember, if we survive stagnation, we can survive any market. Stagnation absolutely destroys even the best of best businesses. And if we survive stagnation, forget about any other era, right? If we survive stagnation, we will survive the grind, and that would be better for us. Historical average will even help us more, and then of course the boom will make our premiums so juicy. We will be retired earlier than our than our expected goal. So, right, if we can survive this era, then we're good. All right, so this is my income pyramid. I'm getting a lot of questions on what I own. So right now, my base, the broad market, right? I have GPIX, GPIQ. I'm going to be building up SPYI and QQQI, and I have QDVO. Right, these are going to be my reliable 8 to 12%ers. Right, that's going to pretty much make up 70% of my base, my core. And then I have the boost, which is the 20%, the rest of the 20%. This is my high volatility, right? So I own Maggie and BTCI, right? These are my tactical 30% yielders. Why this mix? Well, the base ensures survival in stagnation errors, right? The boost captures the upside and boom errors. Well, you're gonna say 70 plus 20 is just 90. Where's the 10%? Well, the 10% I still haven't really decided yet. 10%, I'm going to either go with a 5%er, maybe Devo, or I'm going to go with a 50 to 60, 70%er. I'm not sure yet. I'm going to leave that 10% pretty much in the open. Maybe some closed-end funds. I don't know yet. But with the 90%, I'm going to reach my $120,000 a year goal, and I'm going to go ahead and think about what I'm going to do with the 10%. So leave that in the comments and convince me. All right, survivability, the income shield. This is where we live off the 8 to 15% yield, right? You never sell shares because you don't have to sell shares. You don't realize losses during a crash. You hold the asset forever. The income pays your bills. This completely eliminates SORR, sequence of return risk. And I try to explain this to my friend who has millions invested. It just sucks because I'm seeing him. He could be pretty much retired. He's the same age as me, in the early 30s, and he has a few million invested, but they're all in the 1 to 3%ers. And I'm just looking at him like, man, you don't have to suffer like this, man. Just put like $500,000 in a 10 or 15%er, to really go ahead and juice up your yield. But everyone has their own path. Remember how I say I will never understand why people want to work 40, 50 years if they don't have to. He's the type of person that likes to work. He doesn't mind. He will work the next 40 years. There are some people just like that. You can't help them if they don't want to be helped, right? So what is that saying? You can lead the horse to a water, but you can't force it to drink, or whatever the saying is. Right? I can lead him to the water, but he's not willing to drink it. Right? Not everybody wants to drink the Kool-Aid that we're trying to have them drink. But anyways, so the proof, of course, I want to put in my videos. I want to have some credentials to what I'm, talking about. Yes, I do yap a lot, but I try to make sure I back it up. So we compared my opinion piece to the BXM versus the SP 500. So when I look at the last decade from 2000 to 2010, the S&P return was -9%, negative. But we look at the SPYI, BMX, this is the covered call index return, right? It was positive. The strategy improved its survivability in the worst market of our lifetime. When I say our lifetime, I'm talking about the people my age. Okay, I'm sorry about anyone older, but I am in my early 30s, so I'm trying to let my peers know that, hey, let's not worry about this. There are going to be a lot of naysayers. Remember, don't sell unless your thesis is broken. Unless the prospectus has broken the thesis on why you invested in the first place, right? Ignore the naysayers. Just understand, of course, do your own due diligence and understand what you have bought, why you have bought it. And as long as you understand that, the reason why, and your thesis behind it, we are A-okay. Right, so income is the only hedge, right? So in a 4 to 5% era, you cannot rely on growth. I truly believe that. I really truly believe that, right? You must manufacture your own 8 to 15% return. Okay, so this is just my kind of my thoughts. This video. I hope it was a little educational, informative, but I felt like I had to make this video because it just stuck in my mind why some people do things they don't have to. But as much as I said, I don't understand it. Everyone has a different personality, life goal. Some people just like that cubicle. I really don't. Every time I get into the office in a cubicle, I feel depressed. It's just so depressing. But some people like it, right? I will never understand that. I would never understand the perspective. The same way he probably looks at me and say, why would you invest in anything over 5%, right? He thinks I'm crazy as much as I see him that he's crazy. But that's what makes our relationship great. We understand each other and we look at each other crazy, but we have the good time, we have the bad times, and we agree on our differences. We do, we talk about it. Maybe one day he'll come on my side. Hey, maybe that 10% I'll go back to, the 1 and 3%ers. Who knows? All right, so join the income army. If you're new, subscribe for more high yield strategies. We like to talk about high yield strategies. We like to talk about the good, the bad, the beautiful, the ugly, everything. Drop a comment. Which era do you think we are in? Do you think I'm in? Do you think I have the right era that we're in? Do you think we're just entering the boom, or we're about to leave the boom and go into a bust? Who knows, right? 2026 is gonna be fun. So for those who are new, please leave a subscribe, a comment, a like, and welcome to the channel. And if you're interested in my income journey, please subscribe. Thanks for watching. Catch you guys in the next. Stay tuned.